Good morning, everyone, and welcome to the GIIN's second annual Decision Points webinar, where we will be speaking about different choices that impact investors face when building their practice. I'm Rachel Bass. I sit on the GIIN's research team, and I'll just start by sharing a few housekeeping items before we dive into the content. The first is please note that you're on mute currently, but we do have a chat function in the corner of your window where you're welcome to submit any questions for any of the speakers today, as well as any concerns or technical difficulties you might experience during the broadcast. We also ask that you please use your computer audio instead of the phone lines. And we'll be recording the webinar that we can circulate after the session today. Before we dive into content, I'd like to just quickly introduce the Global Impact Investing Network, or the GIIN, for those of you who are less familiar with us. We are a nonprofit organization headquartered in New York City that's dedicated to increasing the scale and effectiveness of impact investing. And we do this through a number of core programs. The first is our membership, which consists of 270 impact investing organizations and other stakeholders in the impact investing ecosystem around the world. The second is our IRIS and Impact Measurement and Management team, which maintains the IRIS system, including a catalog of over 500 social, environmental, and financial performance metrics, as well as a series of other resources to guide impact measurement and management, or IMM. The third is training, which offers IMM trainings, as well as other educational resources for investors. And lastly is our research, which will really drive a lot of the discussion today. Our research program seeks to address the various knowledge gaps that face the impact investing industry. Before we dive into results, I'd like to invite everyone on the line to contribute to this poll so that we can have a better sense of who all is joining us today. If you could please just click the corresponding buttons to indicate your current level of engagement with impact investing. And while we do that, I'll run through the agenda. So we'll begin with remarks from our Managing Director, Giselle Leung, and then hear a research presentation featuring results primarily from the annual Impact Investor Survey by Research Associate Hannah Dithrich. And then at that point, we'll hear from 3 different investors who are actively making impact investments and can comment on the various choices that they make in shaping their impact investing practices. And lastly, we'll have time for Q&A. So again, please feel free to submit any questions that you might have through the chat function. So our results are coming in. As you can see, we have a very interesting split of folks on the line. About 27% are already making impact investments, 28% are otherwise active in the space, 20% are considering making impact investments, and another 10% are just starting to. So we've got various levels of engagement, but a lot of folks that are really interested in this space. So really happy to have you all on the line and to enjoy this discussion with you. And so with that, I'll pass it over to the GIIN's Managing Director, Giselle Leung, who can share a little bit more about the GIIN and about the webinar that we'll have today. Giselle, over to you.
And thank you everyone on the line for joining us today from wherever you are around the world. And a special thanks to our 3 speakers who we will hear from later on in this call: Neeraj Aggarwal from Michael and Susan Dell Foundation, Daniel Izzo of Vox Capital, and Caroline Vance of Deutsche Bank Asset Management. Before we dive in, and I hand it over to Hannah to highlight the various considerations that impact investors must make when making their practice, I want to take just a moment to make sure that we're all on the same page about the big picture, what impact investing is, and why it is so important to our world today. Impact investments are investments made into companies, organizations, and funds with the intention to generate social and environmental impact alongside a financial return. They can be made in both emerging and developed markets and target a range of returns from below market to market rate, depending on investors' specific strategies and objectives. Now, impact investing is a relatively new market, but it has grown tremendously over the past decade. In fact, highlights from the GIIN's latest impact investing survey underscore the strong momentum in this space. We know that over the past 5 years, impact investing has grown at a compound annual growth rate of 13%. Our latest survey also received the highest number of respondents yet, and many of whom are new entrants to the market. Of the 229 impact investing organizations that participated in the survey, over half of them made their first impact investment in the past 10 years. Now, collectively, they manage $228 billion in impact investing assets. This figure does not represent the whole market size, but does serve as the best available floor for the size of the market. And what's more, impact investors in the survey report plans to increase capital invested by 8% in the year ahead. So what is behind this momentum in impact investing that we're seeing? It is part of a broader shift in attitudes towards the role of capital. As you look at the world around us, it is clear that more capital is needed to tackle many of the world's most pressing and urgent challenges, be it poverty, inequality, lack of access to basic services, climate change. And people are becoming increasingly aware that their investment capital can be a powerful tool to finance all the needed solutions and achieve social and environmental impact. All this is fueling interest in values-aligned impact investment products. And in fact, impact investments can unleash the power of the private sector to create positive global change that improves conditions for people and the planet. At the GIIN, we believe in a future where impact is integrated into all investment decisions. Investors can do more with their money than make more money. They can make their money count. It is truly exciting to see broader financial markets undergoing this evolution in thinking about the role of capital and impact investing leading the way towards achieving this vision. Investors who act now to learn about impact investing and develop an impact investing practice can play a critical role in reshaping the future financial markets and to create a world where their investment capital is a force for good. As interest in impact investing continues to grow, the GIIN is committed to helping onboard new investors who are interested in aligning their portfolios with their values. As Rachel noted at the top of the webinar, the Global Impact Investing Network is a global champion of impact investing with a mission to increase the scale and effectiveness of impact investing around the world. As a field builder, we offer a variety of tools, resources, and programs to help investors build their practice and ultimately advance the development of the industry. You can learn more about these resources and about impact investing on our website. And I also encourage you to check out and experience these activities firsthand at the GIIN Investor Forum in Paris this October. Now, I mentioned earlier that the GIIN's vision is a future where impact is integrated into all investment decisions. And we're spearheading efforts to put the industry on track to achieve this vision through the GIIN Roadmap, which is a sweeping action plan for the accelerated development of the impact investing market. One of the key actions highlighted in the roadmap is about education. Training and educating finance and business professionals about impact investing is key to building this market. And this is why it is so significant to have all of you online today for our discussion. As new players enter the space, we hope to share data and insights about the kinds of choices that investors need to make to get started in impact investing and to build out their practice. This webinar is designed to do just that. In a few minutes, you'll hear firsthand from 3 leading impact investors about the choices they have made, about impact themes, about target returns, asset allocation, and how these decisions about strategies play out in their practice. So I'm thrilled to see all of you today. Thank you for joining us. And now, without further ado, I'll pass it over to Hannah, who will share additional color about the types of decisions that investors make to build their practice.
Fabulous. Thanks, Giselle. So my name is Hannah Dithrich on the GIIN's research team. As you know, the GIIN produces a variety of practitioner-oriented research on impact investing. So today I'm excited to share some key data from one of our flagship publications, the GIIN's annual Impact Investor Survey, which is now in its 8th year. This year we had 229 respondents, making it really the most comprehensive set of data that exists on the industry. So thanks to those of you on the line who participated, and we hope that you'll continue to do so in the coming year. And thanks as well to our sponsors, USAID and UK Department for International Development Impact Program. To participate in this survey, investors must meet 2 criteria. First, they must meet the GIIN's definition of an impact investor. So those that make investments, be it into companies, organizations, or funds, with the intent to generate measurable social or environmental impact alongside a financial return. And the second criteria is that they have to have a certain level of experience with impact investing. So they have to have made either 5 transactions or invested at least $10 million into impact investing. So this way we can ensure that we really get kind of a meaningful set of insights about the industry. So I'll share a few key data points on our sample's characteristics, followed by some data related to 3 key choices impact investors face in defining and implementing their strategies. The first point is that the impact investing industry is an industry that's really growing. This graph indicates what year respondents made their first impact investment. So while you see that many organizations have been doing this for a long time, for example, over 20 years, over half of our respondents actually began impact investing in the last decade. So this indicates lots of growing interest and new entrants to the market. But you may be wondering, who are these impact investors? Well, they represent a really broad range of investor types. Respondents to our sample include fund managers, which make up 59% of our sample, as well as lots of organization types like foundations, banks, family offices, development finance institutions, and institutional investors like pension funds and insurance companies. Our respondents are also based around the world. There's a concentration in North America and Europe, but also good representation from lots of other regions around the world. Another interesting point is that some investors are focused only on impact investing, while others make both conventional and impact investments. So there are many motivations to make impact investments. And this year we asked our respondents about what motivates them. So some of the most common motivations are related to impact itself, as you may guess. For example, that impact investments are part of respondents' commitment as a responsible investor, or that they're an efficient way to meet their impact goals. Other of the top reasons are more financially related. For example, almost half of respondents are making investments to respond to client demand. And many also see them as an opportunity to gain exposure to growing sectors or geographies, or as financially attractive investment opportunities. So across these different motivations, let's go over 3 key questions that investors consider in shaping their approaches. The first is, what type of impact am I seeking to create? The second is, what are my financial return expectations? And the third is, how do I allocate my assets to achieve these various goals? For example, across geography, sector, or asset class. So let's start with impact themes, which are obviously a very core characteristic of impact investing. Respondents to our survey, just over half indicate this year that they target both social and environmental impact objectives. Another 40% target only social impact objectives, and 6% target only environmental impact. And many investors also find it helpful to think of their impact in terms of the SDGs, the Sustainable Development Goals. So just a few years after these goals were established, we see that over 3/4 of respondents indicate that they either currently track the performance of their investments to the SDGs or plan to start doing so soon. And this type of alignment makes really a lot of sense since most impact themes go very well hand in hand with these broad goals. Another point is that the research team is publishing a series of case studies in September on how investors are aligning their portfolios and actually directing capital to the Sustainable Development Goals to help you all get a better sense of how this actually looks in practice. And to understand more specifically what impact themes investors are targeting, last year we conducted research on impact measurement and management practices. So this is a different sample here showing 124 investors. And we see, first of all, that investors target a range of really important impact themes. The most common is decent work and economic growth. But investors are dedicated to other really important topics like health and well-being, education, clean energy, poverty reduction, for example. And in this year's survey, we asked respondents about some of the ways that they measure their social and environmental impact. So we see that almost half of respondents set impact targets for all of their investments. Just over a quarter set impact targets for some of their investments, and just under a quarter don't set impact targets. But regardless of whether or not they actually set impact targets, pretty much universally, respondents are really seeking to understand and measure the social and environmental impact of their investments. The majority do so by developing their own frameworks or methodologies, or by tracking established metrics like those aligned to IRIS, where you see 59% respondents. IRIS is the GIIN's catalog of generally accepted social and environmental performance metrics, which houses over 500 metrics available for public use in shaping your investment strategy. So we talked about impact. Let's talk about the other side to the story, which is investors' target financial returns, where there's also a number of key choices to be made as well. So one of the most unique features of the impact investing market is that investors target a wide range of financial returns, from below market rate or capital preservation to risk-adjusted market rate returns. And the majority of respondents to our sample are targeting risk-adjusted market rate returns. And you might be asking, what do these returns actually look like? So we asked respondents to report on their gross returns. Now, there's a lot of data on this slide, so don't get too overwhelmed. But I'll just show you, we've segmented it in 3 ways: market rate investments and below market rate investments, debt investments on the left and equity on the right, and developed markets and emerging markets segmented out. And the diamonds represent average gross returns, and the error bars represent one standard deviation. So again, without getting kind of too in the weeds, I'll just summarize the key points here, which are basically that these returns reflect kind of what intuition would suggest, which is that market rate investments have higher average returns than below market rate investments, that equity investments generate higher than debt investments, and that emerging markets have higher average returns than developed markets. And one of the most kind of persistent myths about impact investing is that it necessarily means lower financial returns. But what all of this emerging research is showing is that it definitely doesn't need to be the case. Of course, not all investors are even seeking competitive returns. Over a third of respondents to our survey target below market returns, but those that are seeking market rate returns are able to achieve them. And then again, while these returns themselves are self-reported, these overall findings have been corroborated by other really reputable studies, like those by the folks at Wharton, McKinsey, Cambridge, for example, and at the GIIN, we've also created several benchmarks for different asset classes in impact investing. So overall, this reflects lots of promising activity and really adding to a robust and growing evidence base of performance data. And lastly, every year we ask about investors' satisfaction with their impact and financial performance. And we see that the great majority are really satisfied with both impact and financial performance relative to their expectations, and that in fact 15% are outperforming their impact or financial return expectations. So finally, let's talk about what the annual survey data shows us in terms of how investors allocate capital to achieve these various impact and financial goals that I've just described. So as Giselle mentioned, respondents to our sample this year manage just over $228 billion in impact investing assets. So of course, this is a sample. Our survey doesn't cover everyone in the market. So instead of thinking of this as the total size of the impact investing market, it's better represented as a very good floor or an estimate of the minimum amount of capital in impact investing. Another important thing to note is that the typical respondent to our survey is relatively small. At the median, respondents manage about $92 million in impact investing assets. So looking at how this capital is deployed across the world, the first thing to note is that impact investing really does take place across the globe. Just over 50% of total capital is going to emerging markets, and the rest to developed markets. Investors also target a wide range of sectors, as you can see here. About 20% of capital is going to financial services, followed by energy and microfinance. And some of these top sectors are really reflective of investors' commitment to basic services like housing, food and agriculture, healthcare, for example, or education. And lastly, in terms of asset class, impact investing really occurs across all asset classes. The majority of total capital that our respondents manage is in private markets, with just over 40% in private debt and almost 20% in private equity. But investors are allocating across other instruments like public equities as well, public debt, and real assets. So to recap, I've shared some of the key choices that investors can make around these three key questions: the type of impact they seek to achieve, their target financial returns, and how they allocate assets to achieve those various goals. And I'll also note that this is only a small taste of the wealth of data that we have in the full survey and analysis that we've run. So I encourage everyone to download it on our website. We also have a neat interactive data feature where you can slice and dice the data and play around with it yourself. So now we will hear from speakers on the line about how they incorporate these choices in their practices. So I will hand it back to my colleague Rachel to introduce them.
Great, thanks Hannah. And excited to introduce our speakers, but before I do, just a reminder to please send any questions you might have through the chat function. And we'll be happy to answer those once we get to the Q&A at the end of this. And so with that, we'll start with our first speaker, Caroline Vance, who is a director in the Sustainable Investments Group at DWS, formerly known as Deutsche Asset Management. which has been managing outcome-oriented private debt and equity funds since 1997. Since joining Deutsche in August of 2008, Caroline has been responsible for microfinance and social enterprise lending relationships in a variety of geographies, and she has managed 2 of the group's funds. At present, she's responsible for the Essential Capital Consortium, a $50 million fund for social enterprises in financial services, energy, and health. And she is involved in the development of a clean energy access strategy focused on sub-Saharan Africa. Caroline previously worked in the investment banking division of Lehman Brothers, its Global Natural Resources Group, and its Business Planning and Technology Group. And she holds a master's degree in international affairs from the George Washington University and a BA from Williams College. And with that, Caroline, over to you.
Thanks so much, Rachel. I'm really happy to have this opportunity to share the perspective from DWS. Before diving into kind of the main question here, I'll start with a little background since DWS is a newer brand here in America. It's the new brand name for Deutsche Bank's asset management arm, which went through an IPO in March and subsequently rebranded. The slide that you're looking at now is showing the broad organizational structure of the alternatives division of DWS. The group that I belong to is called Sustainable Investments, and it's dedicated to private debt and private equity fund products that have social and environmental outcomes associated with them. The group sits alongside the real estate, infrastructure, and other groups on the alternatives platform, reporting into the head of the division. Our group has about 40 staff located in London, Frankfurt, New York, Asia, and Africa, focused on several broad sectors: financial inclusion, clean energy, and agriculture, with experience also in financing social enterprises that are expanding access to basic products and services for low-income communities in other sectors, such as health and education. We source assets for our portfolios directly rather than through investments in other funds, and we have a respectable history of working in this space, reaching back more than 20 years to when our first financial inclusion investment vehicle was launched. I want to turn now to the next slide to illustrate how our group's mandate within DWS drives the shape of the impact and the returns that we seek. You may recognize this slide. I find it to be so useful in framing the intentions when it comes to ESG and impact, and I borrow it quite often. Our group has a mandate to put together funds that are actively seeking positive social or environmental outcomes, which puts us more on the impact end of the ESG impact spectrum that you're seeing here. Our funds span the area under the Sustainable Investment Opportunities heading on this slide. This means first that our funds will seek out themes where we see the possibility for positive impact. Second, they'll have articulated investment theses that lay out how we expect the fund's investments to contribute to that positive impact over time. And third, they'll have identified metrics that will be tracked and reported to serve as indicators of progress toward the longer-term goals of the fund. The specific metrics that are tracked will depend upon the theme of the fund. On the next slide, we're laying out in more detail the cornerstones of our group's mandate. In addition to seeking positive social and environmental outcomes, we also have a mandate to create products that are aimed at the DWS client base, which is primarily institutional. A lot of discussion in the last few years about impact investing has focused on how to engage more institutional investors to move money off the sidelines and into impact. And to achieve this, there have to be more products that meet the needs of institutional investors, which means that they must have sufficient scale and they need to have competitive financial returns. Our funds have to meet these 2 criteria, and that shapes how we structure our funds and where we engage. We need to be able to demonstrate that our funds are built around a risk-return proposition that would be broadly comparable to other funds that an institutional investor would consider. And this is, of course, a little bit easier said than done, considering that often in the impact investing space, there are situations where it's challenging to point to a comparable fund or a benchmark. However, in some areas, a track record is growing. In financial inclusion, for example, we are able to point to 20 years of our own investment track record, and we can use that record to justify the risk-return proposition for institutional investors who are looking at investing in our financial inclusion funds. with sectors that might not have such a robust history, we need to create a structure that can provide enough support to make institutional investors comfortable. And here we can look to blended finance as a model. One example of a theme where we see an appropriate role for blended finance is energy access, because this is a social and environmental challenge that is felt most deeply in countries that carry a significant amount of country risk, and because many of the companies that are seeking to address the issue are relatively new, we would see a critical role for catalytic investors in a fund that's dedicated to this issue. And we can create a structure that leverages their commitments to crowd in the more traditional types. So to summarize in one sentence, in DWS's Sustainable Investments Group, we're trying to engage institutional investors at scale with the purpose of moving the needle on major environmental and social challenges. And this goal has indicated our approach to how we design the impact and return propositions of the products that we create. And I'll just stop there and happy to answer any questions later in the session.
Great, thank you, Caroline. And with that, we'll move over to our second speaker, Neeraj Aggarwal, who's a program director working alongside program teams in India and the US in executing and managing mission investments at the Michael and Susan Dell Foundation. The foundation has made catalytic mission investments across its India-based microfinance, health, and education initiatives, and its US-based education and health initiatives. Neeraj previously spent 5 years in investment banking in Australia and has a Bachelor of Commerce, Bachelor of Laws degree from the University of Sydney and an MBA from the London Business School. Neeraj, it's over to you.
Okay. Thanks, Rachel. So pleasure to be here, and Caroline, thank you for that presentation. It was fascinating. Slightly different angle here, and this is really coming from the foundation side of things. So I want to start by providing a bit of an overview of Michael and Susan Dell Foundation, and then diving into how we think about impact investments at the foundation, both in terms of the organizational aspect of it, and then in terms of what we look for. So on the next slide, you'll see that our basic anchor, our basic mission is to transform the lives of children living in urban poverty through better education, health, and family economic stability. That's our anchor. When we think of impact investing, we look at the impact aspect of it, and our impact is actually linked to this. Internally, we call it mission investing because all of our investments want to be linked to this mission. Now, we didn't start impact investing as a foundation until 2006 in India and until 2014 in the US. We are predominantly a grant-making organization or grant-making foundation. We have about $1.5 billion committed as at December 31, 2017. And the Dells committed another $1 billion last year, so that will keep us going for another 10 or so years. Our global annual commitments, we call it giving internally, is about $115 to $120 million per year. That excludes something called the Rebuild Texas Fund, which is a private philanthropic fund that we raised after Hurricane Harvey. Moving on, just to give you a sense of the portfolio at MSDF, there's quite a few numbers here, I realize, but the bulk of our impact investing activity takes place in India. It's a $76 million total portfolio in terms of the commitments, and $55 million of which were paid out. Almost 80% of that is based in India, and that's a function of the fact that we've been active in impact investing in India since 2006. The remainder is really in the US. In our South Africa team, we haven't made in fact, we haven't made any PRIs just yet. That $76.3 million represents about 7 to 8% of our overall giving. So I mentioned our overall giving is about $130 million a year, and that that 76 million represents about 7 to 8% of our overall annual giving. Just moving on, the portfolio, the impact investing portfolio at MSDF has grown quite considerably. It took us a long time to get started. Like I said, our first investment was in 2006 in India. It took us 7 years to make 15 investments and deploy $70 million of capital. We were really trying to find our footing in India for a long time, especially trying to figure out how the impact investing function incorporates or meshes with the grant making function. But once we built up some of the organizational attributes, which I'll talk about, over the last 4 or 5 years in particular, we've really started to ramp up, made 28 investments, deployed almost $60 million, and on a pretty steady and growing trajectory going forward. So now to give you a sense of kind of how we think about impact and impact investments in particular, on the next slide, it shows the 3 program areas and the 3 geographies. So we've talked about 3 geographies very briefly, but these 3 program areas are really our guide. Urban education, family economic stability, and childhood wellness. So just to give you a sense of how the foundation is structured and therefore how that drives our impact investments. So underneath each of these program areas, there is what we call an anchor statement. And that anchor statement, if anyone visits our website, you will see that I think there's about 8 or 9 anchor statements. And those anchor statements have, pretty precise metrics associated with them, and they have a certain specific strategy associated with them, but it's kind of broad enough to be encompassing across the 3 geographies, but also specific enough to give us an idea of what it is that we need to focus on. So for instance, under the urban education program area, there's an anchor statement which is each year we will create opportunities for over 3 million low-income students globally to attend high-quality schools. So that's an anchor statement that we have which fits under the urban education. So then what happens if we move on to the next slide, the way that we think about it from there is that we think about this in 3 different categories to start off with. So that anchor statement is what's going to drive our strategy. Now, the program officers manage a portfolio of dollars. So that could be anywhere between $3 million to $10 million, or maybe even more for some POs. And they will be given relatively high levels of latitude and freedom to fund different projects that align with that particular anchor statement. So importantly here, there's no minimum number of impact investments that any program officer needs to make. They have the full spectrum of tools, funding tools available to them: grants, contracts, debt and equity, guarantees, whatever. There is actually no minimum on any or no maximum on any. What tends to happen is that being a philanthropic funder, we tend to take a systems level approach, systems view of a particular problem. So in relation to quality schools that I mentioned, we certainly won't default to making a minimum number of impact investments, but we'll think about what are the systemic bottlenecks, what are the inefficiencies, and what can we do as a philanthropic funder in order to try to cure those market inefficiencies or system inefficiencies. Now, a PRI may fit into that, but also may not. So strategy, context, and resources are the 3 basic attributes that we have that which guides the willingness and the ability of a program officer to make an impact investment. On to the next slide. What we've realized as a foundation is that we've also needed and we've developed infrastructure, process, and culture. So what that means is that program officers do not naturally make or default to impact investments. And so about 5 years ago is where we set up a specific impact investing or mission investing function at the foundation, what we call infrastructure. And I was one of those people, and then I have a counterpart, Neeraj Aggarwal in India, and Aditi in India, who basically work with the program officers to help them execute debt and equity investments, recognizing that it calls upon a more nuanced, perhaps more technical skill set relative to the program officer, ordinary program officer skill set. So the infrastructure piece, providing that support and technical assistance alongside the program officer, has been a critical part of the growth of the function and the foundation. The other thing on process is that we've realized that in order to scale this operation at MSDF, we had kind of a grant-making system and grant-making processes that didn't lend themselves naturally to debt or equity style investments. And I'm sure folks on this call will appreciate this, whether you're coming from the the commercial side or the philanthropic side, there is no natural impact investing system or process that we know of. So what you find is that most systems out there are a modification of either traditional investment or grant-making systems, and both have their limitations. So we found that there's a significant investment that we've needed to make in getting the systems and the processes right. And the final thing is culture. This is challenging. When you're working in a grant-making organization that's used to making grants for the better part of its lifetime, to suddenly say that we're making debt and equity investments, even though it hasn't been sudden, is challenging. It requires a different way of thinking about organizations or problems, but it's fundamentally a very powerful way that that it complements our grant making. So catalyzing that mind shift has probably been, of all the different attributes, the most challenging part of the role at the foundation. So they're kind of the basic organizational attributes that we've developed in order to optimize for impact. Now, in terms of how we think about or rank or evaluate potential investments, there are 7 factors, just moving on to the next slide, and they fit very neatly into this acronym called MISSION. Now, I will say that there is no necessary prioritization or elevation of one factor over the other. When the program officer looks at each impact investment, they will look at all 7 of these factors. We have an investment committee. They'll also look at all 7 of these factors. And so those factors are market, which I'll talk about a little more, impact. So there's a programmatic impact, but then there's an impact associated with a particular organization, and whether the impact of the organization delivers aligns to the impact of the program. Scale and sustainability, and these are 2 of the primary factors why we would pursue an impact investment versus a grant. The next 3 factors, incrementality, organization, and nexus. And these are more factors aligned with traditional investment making. Incrementality, knowing that there is a particular use of philanthropic dollars. Organization, looking at the leadership capacity. And next, i.e. looking at follow-on and repayment or exit opportunities. The final slide that I'll talk about is one of our favorite slides in terms of helping us think about when and why an impact investment makes sense. The reality is what we have figured out is that an impact investment makes sense where there is a market-based solution. And that is where, in the top right, that consumers or beneficiaries have the ability and willingness to pay. The reality is that the vast majority of markets that we're operating in, or vast majority of systems that we're working in, I should say, don't have a market solution. And that's because either there is the lack of ability to pay or lack of willingness to pay. And that is where a philanthropic solution, and therefore folks like us, play an important role. So in all of our, when I was saying that a program officer thinks about this from a systems perspective, this is kind of what I was talking about. They're thinking about ability and willingness to pay of a beneficiary base, and thinking about what they can do to increase ability or increase willingness. So I'll stop there. I wanted to ensure that folks knew of the resources on our website. If you're curious, we've just put out a case study that was co-authored by NYU. Just on the next slide, I've given that URL there, www.msdf.org/impactinvesting, and there's also a link to the case study which has specific investments that align with each of the factors that I talked about in the organizational attributes. So I'll pause there, and once again, thank you all, and happy to take any questions later in the webinar.
Great, thank you, Neeraj. And so now we'll turn to our third and final investor presenter, Daniel Izzo, who is a partner and co-founder and CEO at Vox Capital, Brazil's pioneering and leading impact investing fund manager. Vox Capital has been listed for 5 consecutive years on Impact Assets 50 and was the subject of a Harvard Business School business case, Vox Capital, Pioneering Impact Investing in Brazil. Daniel is a member of the Global Executive Committee at the Aspen Network of Development Entrepreneurs, a member of the board of the Brazilian Social Finance Task Force, a leader of the Impact Investing Working Group at the Brazilian Venture Capital and Private Equity Association, and a professor at the Impact Investing Executive Program at the Said Business School in Oxford. Daniel, over to you.
Hi, thank you. First of all, it's a pleasure being here with you, sharing a little bit the perspective of the local fund manager in an emerging market, and a little bit of our challenges on defining what we're looking for and how to best balance the impact and the financial return, and how we make choices on asset allocation based on that goal. So first, a little bit of background on Vox. We're founded in 2009, so almost 10 years now. Our first investment, impact investment, was in 2009. 2012, we have two funds, one launching in 2012, one in 2016. We're close to $70 million in assets under management. And this year, 2018, earlier this year, we announced the first successful exit in equity investing, in impact investing in Brazil. It was a prepaid card for private health services, for low-income private health services, and we sold it to an international insurance company. And we're calling it a successful exit because it combined a very healthy financial return. It was a 26% internal rate of return over 4 years we worked with them. And on the other hand, the exit was to a company who was willing to include more services to the prepaid card. So one thing that we did not have was insurance or hospital services, and this insurance company was buying the asset to increase the services being offered to the client of the service. So we're very happy with this, because Vox, since 2009, when we started working with impact investing in Brazil, one of our, as you may have noticed through my resume, we're very much focused on also developing the ecosystem, the Brazilian ecosystem for the team. And one of the key challenges to it was bringing and showing success cases so people can believe that you can actually bring both things together. So very happy that this is taking us to what we think is the right direction. So if you can move to the next slide, please, where I start talking a little bit about the market in Brazil, right? I know it's an international call, so I'm selling a little bit Brazil here, and we think Brazil is one of the best places for impact investing around the world, because we combine a very large economy. Despite the crisis, we are not only one of the 10 largest economies, but we are one of the 5 largest internal markets in the world. So big market, very dynamic. But we are consistently ranked as one of the worst countries in wealth distribution by the GIIN index. So we have at the same time like strong private sector, but we still have almost 60% of our population living under $9 a day. So we see Brazil as one of the best places in the world to develop business solutions to tackle actual problems from the low-income population. So we can move forward. And our focus on that is on the 3 main areas, which is fostering the local human potential, which covers pretty much education, vocational training, and related areas, increasing well-being, and we will include health care solutions, prevention, the prepaid card for low-cost medical services, And the third one is developing new models for financial inclusion. So that would cover financial services mostly. And the three of them are, as we're looking into equity investments that have to be scalable, it's a big country, you're looking to solutions that are technology enabled. So they're offering these solutions enabled by technological solutions. So these three sectors are not were also chosen because of this balance between the potential impact. These are basic services for people living in urban poverty. Brazil is already close to 90% urban as a country, population. But on the other hand, these are three sectors that are very large and dynamic in the economy. So even during the crisis we've been through in 2015 to 2017, we had lots of M&As and public and large private equity companies, local and international, investing in companies within these sectors. So these are also sectors where we can have a clear exit strategy to them. So next slide, please. But this doesn't make our lives easy. So this is I'm showing what we've done. So right now we have invested in 22 portfolio companies over time, but we have to look at close to 1,800 ideas at more than 800 meetings, because it's a very distinct profile that we're looking at. We need scalable businesses. We need teams with complementary skills, teams that work well together, that have some experience, that we can believe that they will deliver the business plan, and they are impact-oriented. So even the team has to bring this balance of being able to deliver a scalable, impactful business, but there are concerns about what they're doing and what are the solutions that they're bringing. So every investment that we make, we create a theory of change with the entrepreneurs. It is a key part of our selection process. And this is on the right-hand side of the slide is a distribution of the pipeline that we're seeing, still very concentrated on the southeast part of Brazil, where most of the economy happens, economic activity happens in Brazil. But we're very happy to have made our last investment on the northeast side, where we have only 3% of companies, and it's a very promising company that we believe, if successful, can also start developing a local ecosystem for impact investing, improving the chances of us having national activity on this team. So pretty much on a nutshell, this is what I wanted to bring to you. So there's a lot more to it, as you can imagine, but I'll be here and available for questions that you may have. Thank you.
Great. Thanks, Daniel. And thanks again to Neeraj and Caroline as well. I realize that we only have about 5 minutes available for Q&A. And so what I'd like to do is invite each of our 3 speakers to share one thing that they've learned from their time in impact investing. So this could be a way that you've overcome some kind of challenge, a way that you've refined your impact measurement and management strategy, or something you've learned about portfolio allocations and investment management. And so let's start with Caroline, and if you could just share one item that you've learned from your experience in the field that you'd like to share with those on the line.
Sure. I'm happy to share something. I think it's hard to narrow down to one thing, honestly, but I think the most important thing for us is to acknowledge and kind of spread the word of the importance of laying out the impact thesis very clearly from the beginning. And both of the other speakers also referred to the different theories of change and the different anchor statements that each uses. And having something like that does anchor you as an investor to what you're trying to achieve, and also makes it very clear from the beginning to all the investors who are signing up with you what you're trying to achieve and how you plan to do it. I think that's absolutely critical, and that's something I think the importance of which has been sort of learned over the last 10 years kind of in this broader impact investing industry.
Great, thanks, Caroline.
Yeah.
And Neeraj, is there one thing that you could share with us that you've learned from your experience?
Yeah, I think Caroline put it really nicely. I would say just being clear, unequivocal, and unapologetic about impact. I find that, and I'm saying that from a foundation standpoint, where our clear charge is to optimize for impact. I find the middle ground to be challenging and fuzzy, but it is really important not to apologize for trying to incorporate impact, which sounds like a surprising statement, but often in this field you can kind of apologize for, hey, it's also helping a problem here, and I apologize that might discount financial returns a little bit. Like, no one says it like that, but that's the gist of it. So I think for us, we've started to incorporate mandatory buyout clauses. We set the impact thresholds with the grantees or the investees at the upfront, just so that they're aligned on what the impact goals are, and there's a mandatory buyout if they fall short of that. So that's been a big, not just a big learning, but a big thing that we've started to incorporate into our legal documents as well.
Thanks. And Daniel, any item learned or piece of advice that you could share as well?
Yeah, so these are two great points that both Caroline and Neeraj brought. And I would add one that is very specific to people like doing direct investments in entrepreneurs, which is the focus on the team more than on the business plan, right? So we had an instance where we fall in love with the business idea, but then we invested in teams that were not that great. And I'd say, like, focus mostly on who is doing the work, and these are the ones that we have to adapt, and all the business plans, all the PowerPoints and Excel files that you receive are going to have to adapt to the real world. So the team is key to that, and not only on the capacity of creating value, but also on the alignment towards the impact. If they are aligned towards the impact, you as an impact investor can be sure that they are not deviating for their mission over time. Otherwise, you can't. So focus on the team it's critical, and I can't emphasize enough that.
Great. Well, thank you all. And I realize that unfortunately we weren't able to go through all of the questions submitted today, but we will do our best to follow up individually after this session. And again, as a reminder, we did record the webinar, and we'll be able to distribute that recording and the slides from the conversation today. So as Giselle mentioned at the top of this conversation, we are hosting the GIIN Investor Forum in October in Paris, and would invite all of you to join us in Paris for a few more days of in-depth conversation about impact investing. And in the meantime, feel free to download the annual Impact Investor Survey featured today, or any number of our other resources through our website, and sign up to receive our newsletter so that we can stay in touch. Thank you all for joining, and many thanks especially to our speakers today who provided such a rich conversation for us. So thanks again, and thanks for joining.
Please